Welcome to the Let's Grow podcast, and welcome back to another deep dive. I've been looking at the real estate market lately,
Mhm.
and honestly, it kind of feels like we're in a hall of mirrors sometimes. On one hand, you hear about prices cooling, maybe even dropping a bit in some big cities, but then you see these reports that nearly 40% of homes listed for sale right now have had to cut their asking price. What's that about? How do those things fit together?
It's a really fascinating disconnect, isn't it? And what immediately stands out to me is just uh, how rapidly the whole narrative has shifted. I mean, just a few years back, it was this absolutely furious seller's market, right? And now, yeah, that 40% price cut figure, especially hitting a 15-year high for June, it just suggests this fundamental rebalancing. It's definitely not a one-way street anymore.
Exactly. And that's precisely our mission today. We're going to try and navigate the complexities of this June 2025 real estate landscape for you. We've really dug into a wealth of sources. We're talking reports from NAR, the National Association of Realtors, Apartment List, Moody's Analytics, plus a bunch of industry experts. Our goal here is to pull out the most important nuggets of knowledge, give you the context, and really help you understand what's truly happening in both residential and commercial real estate. Takes you some reading time.
Yeah, if we zoom out a bit, it's really about identifying where the power has maybe shifted and where new opportunities might be popping up from these subtle, sometimes counterintuitive market movements.
Okay, so let's unpack this starting with residential real estate, because it really does feel like a story of, a slow thaw. We've heard about national home values flattening out, but what's the actual data saying? I saw the median existing home price hit, $422,800 in May, but the year-over-year growth was just 1.3%. That seems remarkably low compared to recent years.
That 1.3% figure is definitely the smallest annual increase we've seen in years. It signals a clear deceleration. But what's maybe even more telling is the regional difference. While the national averages are flattening, in many of those popular Sunbelt markets, the ones that saw that explosive growth during the pandemic, prices are actually below last year's levels now.
Hello last year. Wow.
So this isn't just a cooling, it feels like a direct response to maybe some overextended gains in those areas.
Okay, so prices are stabilizing, even dipping in some spots. What about the actual supplies, the number of homes on the market?
Mm.
Are buyers finally getting more choices?
Oh, they absolutely are. We've actually hit a 5-year high in total homes for sale. We're talking about 1.54 million listings, roughly.
A 5-year high.
Yeah, and that's a significant jump, 32% more than just last June. And homes are sitting just a bit longer now, too. The median days on market in May was 27 days, up from 24 last year. And this ties directly back to that 40% of listings cutting prices, right? Sellers are having to adjust their expectations. The market now gives buyers more choice and, frankly, less frantic competition.
32% more homes and 40% price cuts. I mean, that sounds like a huge shift in leverage towards buyers, yet sales volume is still pretty low.
Yeah.
So what's the single biggest obstacle? What's holding back the actual transactions? Is it just the rates, or is there something else less obvious going on?
Well, there are definitely other nuances, but those persistent 30-year fixed mortgage rates,
Hmm.
hovering around, 6.8% to 7%, they are, without a doubt, the primary handbrake here. It creates this thing people are calling a payment ceiling.
Payment ceiling.
Yeah, a lot of potential buyers simply cannot, or maybe they're just unwilling to afford the current prices at these elevated rates. It's a very real affordability crunch.
And it's not just about the new buyers struggling, is it? What about all those homeowners who, locked in those super low rates a couple of years ago? Are they part of the issue?
They're certainly a big factor contributing to the low sales volume. It's what we've been calling the golden handcuffs effect.
Ah, the golden handcuffs.
Right. Why would you trade a 3% mortgage for a 7% one, even if you wanted a different house? That reluctance to move significantly limits the new supply coming onto the market. It keeps things tight. And even though wages are rising, that affordability gap is still there. It means buyers are often purchasing only if they absolutely have to.
Mm.
And you see this caution reflected in increased contract cancellation rates too. It's a clear sign of buyer jitters, price sensitivity.
So, okay, home sales are stabilizing, but at these incredibly low levels.
Mm-hmm.
May's existing home sales rate was 4.03 million annually. Just to give context, that's near historic lows, almost like 1995 levels.
Yeah, it's quite low.
It tells me buyers are super cautious. I saw 44% of listings were sitting unsold for 60 days or more. That's the highest since 2020.
That cautious buyer behavior is definitely undeniable. But here's what's crucial, and often gets missed when comparing to past downturns like, say, 2008. Today's sellers are largely in a really strong equity position. They aren't underwater on their mortgages like many were back then.
Right, that's a key difference.
Huge difference. It means they have the luxury of choice. They can often choose to just wait rather than sell at a deep discount. And that's a key psychological factor that helps prevent a really steep price crash, even with inventory rising.
Okay, and that leads us perfectly into how geography is playing such a huge role now. It's definitely not one single national market, is it? So where are we seeing pockets of strength, and where are things maybe struggling more?
Well, the Northeast and the Midwest have actually been surprisingly robust. They saw sales up maybe 4 or 5% year over year in May, and prices up 7.1% in the Northeast and about 3.4% in the Midwest.
Really? Why is that?
Well, the thinking is these regions didn't have quite the same dramatic, pandemic-fueled booms as some other areas. So their demand has just been more stable, less volatile.
Okay, and the flip side, where are areas having a tougher go of it?
Absolutely. The South is more of a mixed bag. Sales were down just slightly, 0.5%, and prices actually dipped 0.7% from last year. But the Western region, that remains the weakest. Sales down a pretty notable 6.7%.
Wow, 6.7%.
Yeah. And what's quite striking there is how the affordability crunch, especially after those massive price run-ups, is really hitting places like, say, Austin. We're now seeing genuine buyers markets pop up in certain segments in cities like Denver, Seattle, Phoenix, too. That definitely wasn't the case just a year or two ago.
Okay, so we've got this really nuanced picture for residential. What's the general expert consensus looking out for the rest of 2025? Are we heading for a big rebound, or is it more this slow thaw?
The consensus seems to be that the market is near, or maybe at, its price inflection point. National home prices are probably going to end 2025 roughly flat, maybe slightly down compared to where we started the year.
Flat to slightly down.
Okay. Yeah. And the key driver for any real improvement in sales volume, it's going to be mortgage rates. If they drift lower, maybe even by a full point, say from 7% down towards 6%,
That would make a difference.
it could genuinely unleash some pent-up demand, absolutely. So yeah, the overall outlook really is for a slow thaw rather than some dramatic crash. Gradual improvement, but it's heavily hinged on interest rates and just general economic sentiment.
Got it. Okay, that brings us to commercial real estate, which sounds like it's truly a tale of two, maybe even three, completely different markets playing out. You mentioned higher financing costs or a general headwind, but it's not hitting all sectors the same way, is it? I actually saw transaction activity picked up a bit in early 2025. Q1 volume up 11% year on year.
You're exactly right. It's highly fractured, highly sector-specific right now. So while cap rates, that's the properties yield investors expect, have certainly moved up, maybe into the 6-7% range or even higher, which, yes, inherently lowers property values across the board. Some opportunistic buyers are definitely out there seizing what they see as bargains, particularly in sectors with stronger fundamentals, like maybe multifamily or industrial.
But what's most striking, like you hinted, is the deep strain in the office sector. Some of the numbers around vacancy rates are, frankly, shocking.
They truly are. National office vacancy hit an all-time high, 20.6% in Q2 2025, the second quarter.
20.6%, 1 in 5 offices empty.
Basically, yes. 1 in 5 office spaces is sitting vacant. And major downtowns, places like San Francisco, Manhattan, they're particularly hard hit. Some towers there are seeing 30, even 40% vacancy.
Wow.
And the bigger picture is that physical office use, people actually going in, it's still stubbornly low, still hovering around 50% on an average day across the country. This doesn't feel just cyclical, it feels more structural.
Yeah, less like a downturn, more like an existential crisis for some office buildings. And we're talking sharp drops in property values, 20% to 50% down from pre-pandemic highs.
That's the range we're seeing reported, yeah.
And it's not just values. CMBS delinquency for offices that's commercial mortgage-backed securities is above 10% now.
Yeah.
Hit 12.7% in Q1. For our listeners, that means a big chunk of loans tied to these large office buildings are failing. That's alarming.
It is alarming, exactly. And we've all seen headlines about distressed sales, right? Like that San Francisco tower selling at what? A roughly 75% discount to its 2019 value?
75% discount. Ouch.
Yeah. And even major institutional players, names like Brookfield, Blackstone, they're doing these strategic defaults on some underperforming office assets, basically just handing the keys back to the lenders rather than keep pouring money in.
Okay, so despite all that gloom and doom in office, are there any glimmers of hope? Any opportunities, maybe?
Tiny glimmers, perhaps, yes. For example, Apple bought that office campus in Sunnyvale for $350 million. They already occupied it, but it shows that select, really well-located offices can still attract investment. especially from owner users who need the space for their own operation.
Right, if you're actually going to use it yourself.
Exactly. But connecting this to the bigger picture, the challenges are structural. They're not temporary. Vacancy could still creep up to maybe 20–22% nationally before it finally stabilizes. Creative solutions like adaptive reuse, converting offices to residential or maybe lab space, that's going to be absolutely crucial, though it's incredibly complex and expensive to do.
Okay, so office is clearly struggling. But here's the surprise, something I certainly didn't see coming a few years ago. The retail sector seems to be having this quiet comeback story. Totally different from offices. National retail vacancy is remarkably low, like 4 or 5% for shopping centers.
Yeah.
What's driving this resilience? It's unexpected.
It really is unexpected for many, but it's kind of a classic supply and demand story playing out. Retail is benefiting from very little new construction over the past decade or so. Plus, some older retail space got effectively reused for other things.
Ah, so supply got tight.
Exactly. That tight supply, combined with surprisingly robust consumer spending, is really fueling this resurgence.
And we're seeing that actually translate into rising rents and values too, aren't we?
We are. Retail rents have been gradually ticking up, maybe 1–2% growth in the first half of 2025. And Newmark research even showed retail leading commercial property value appreciation up 4.6% year over year in Q1.
Leading retail.
Yeah. And nationally, store openings are now actually outpacing store closures. That's a fantastic sign.
That is a turnaround.
And investor confidence is following. You see deals like Simon Property Group buying Miami's Brickell City Center for over $500 million, $512 million. That underscores this renewed belief in high-quality retail assets. It's truly become sort of an unexpected star in the commercial real estate world right now.
An unexpected star. I like that. Okay, so retail is thriving. What about industrial? We know it was absolutely red hot during the pandemic with the e-commerce explosion. Is it still booming, or has it settled down?
It's definitely cooling from, red hot to just robust, still strong. The industrial and logistics sector isn't seeing that runaway growth anymore, but the fundamentals are still solid. National vacancies around 7.5%. Now, that is up from the crazy lows of maybe 4% during the peak.
Right.
But historically speaking, 7.5% is still relatively low. It indicates pretty healthy demand. Rent growth, though, has flattened out, basically 0% quarterly growth nationally. New supply is finally catching up with demand there.
That sounds like a healthy normalization, really. For a sector that saw such insane growth, are investors still interested, even with rents flattening?
Oh, absolutely. Investors still value industrial for its long-term prospects, definitely. We've seen major players like Blackstone strategically selling off portions of their huge logistics holdings, like that $120.5 million South Florida portfolio they sold to Ares Management. That shows there's still strong appetite for good infill industrial assets.
Okay.
And new development is slowing down now, which is actually healthy. It'll help prevent oversupply down the road. So the outlook remains positive. Demand from e-commerce is still there. Manufacturing reshoring provides a boost. Infrastructure spending helps. These are all tailwinds. Industrial still remains, in terms of fundamentals, arguably the most robust commercial sector overall.
Okay, so we've broken down residential and the different commercial sectors. They all have their own stories. But what are the big overarching macroeconomic factors that are really shaping all of this, connecting these different trends?
Yeah, the primary common headwind, the thing affecting pretty much all real estate sectors in 2025, is unequivocally high interest rates. The Fed funds rate is still elevated, right? Hovering around 4.25% to 4.5%. And that directly translates into those stubborn 30-year fixed mortgage rates staying near 7% and even higher rates for commercial loans.
Right, it touches everything.
Everything. And while, yes, experts anticipate potential gradual rate cuts maybe late in 2025 if inflation behaves, financing is definitely going to remain expensive in the short term. This makes interest rate movements the absolute swing factor for any kind of significant market turnaround. It's what everyone's watching.
And inflation itself is still a factor too, right? Not just for consumers, but impacting things like construction costs.
Indeed. Consumer price inflation is running around 3–4% in mid-2025. That's lower than the peak, sure, but still above the Fed's target. And while maybe costs for materials like lumber have moderated a bit, labor costs remain sticky. They're still rising, partly fueled by that wage growth we see. So this keeps the cost to build new buildings high, which paradoxically kind of supports the value of existing properties in the long run.
Ah, interesting point.
But it slows down new development right now. And there's also this quirky twist. ongoing trade stuff, tariffs, that adds uncertainty to bond markets, which can actually keep long-term rates higher than they might otherwise be.
But, okay, on a more positive note,
Mhm.
we keep hearing about this surprisingly strong labor market that must be providing some kind of floor, right?
Yeah.
Underpinning demand.
That's a crucial point. Absolutely crucial. Unemployment is low, around 4.2%. Wages are rising, maybe around 5% year over year. This robust job market is really the bedrock here. It directly supports housing demand. It's a big reason we're not seeing a steeper price crash.
Right. People need somewhere to live, and they have jobs.
Exactly. And it also keeps tenant demand solid in those industrial and retail sectors we talked about. If people have jobs and their incomes are rising, they can afford to rent apartments, buy houses, and importantly, spend money in stores and online. That provides a fundamental layer of stability for real estate pretty much across the board.
So, given all these cross-currents, you've got high rates, but strong jobs, these diverging sector performances, what's the feeling among investors overall? Is there still a lot of money waiting on the sidelines?
The sentiment is probably best described as cautiously optimistic for the medium term, but still quite guarded right now in the short term. There is definitely significant dry powder, that's investment capital, waiting to be deployed. Lots of it.
Waiting for what, though?
Waiting for more clarity, primarily on interest rates. However, this persistent higher for longer narrative about interest rates has definitely put a damper on the psychological sentiment for many players. A lot of them are just observing, waiting for clearer signals, waiting for the dust to settle a bit before committing significant new capital.
Okay, makes sense. So, pulling this all together, what are the strategic takeaways for you, our listener? If you're trying to navigate this market right now, whether buying, selling, investing, how can you best position yourself?
Yeah, good question. First, I'd say educate yourself and set realistic expectations. That's key. For buyers, the big insight is inventory's up, competition is down. That gives you more negotiating power, more time to think. The old idea that list price is just a suggestion, it's kind of back.
Good news for buyers.
Definitely. And for sellers, you just have to acknowledge that the market has fundamentally changed from that 2021 frenzy. Strategic pricing from the get-go, maybe some prudent improvements, and definitely patience. Those are key now to getting your home sold effectively.
And this means adjusting your strategies pretty significantly, right? So as a buyer, you can push harder for concessions, help with closing costs, maybe, and normal contingencies like financing and inspection clauses. Those are back in full force. They give you critical protection. And for investors, maybe shift focus. Look at segments with potential upside, like acquiring smaller multifamily properties while prices are maybe a bit softer. Or for the really opportunistic, looking at those dislocated commercial assets. Not just distressed, maybe, but good properties in temporarily struggling sectors, just waiting for the market to turn.
Exactly. Keep your eyes open to spot those emerging opportunities. Be on the lookout for motivated sellers in residential, maybe someone who has an older, low-rate mortgage they can't take with them or a specific reason they have to move. Also remember, high-demand niches like entry-level homes, those are still moving relatively quickly in many markets. And in commercial, yeah, those opportunistic investors are definitely circling distressed office assets or maybe considering buying land in prime spots, banking on future growth, or that adaptive reuse potential down the line.
And finally, I think it's crucial to leverage these macro insights we've discussed. Understand how the broader economic trends, Fed actions, inflation reports, jobs numbers, how they directly impact your real estate decisions. Knowing that makes you a much more informed, more confident participant in the market. It lets you react strategically, not just emotionally, to headlines.
Absolutely. So, to kind of recap, the real estate market in mid-2025, it's really a complex story. It's about moderation, strategic shifts, and this widely diverging performance across different sectors. It's definitely not a single simple narrative. It's a market that's finding its footing, adjusting to a new normal. And understanding these nuanced trends, hopefully without getting totally bogged down in information overload, that's what allows you to make truly informed decisions, whether you're thinking about buying, selling, or investing.
So as this market continues its slow thaw, here's maybe a final thought-provoking question for you to ponder. What creative new uses might we actually see emerge for all that abundant vacant office space in our city centers? And on the flip side, how will the continued shifts in how and where we spend our money further reshape the physical retail landscape? Maybe in ways we haven't even imagined yet.
Good questions. Definitely reflect on how these insights apply to your own situation, whether you're actively in the market or just trying to stay informed about one of the biggest economic drivers out there.
Thanks so much for joining us for this deep dive into the real estate market. We really hope you feel more informed and maybe a little more empowered navigating it all. Until next time.